God. Oh my God. Sell your stocks. Sell all your stocks. The market's going to crash. Oh my God.
Welcome back to Strongman Personal Finance. I'm your host, Christopher Bell, certified public accountant and long-term Boglehead investor. Today, ladies and gentlemen, we're going to talk about the inevitable stock market crash that's going to occur in the United States. Now, I always talk on my channel about how you can't predict the future. You just don't know. And if you can't predict the future, how do you know there's going to be a stock market crash? Well, let me tell you what, ladies and gentlemen. If you look back in history, there have been tons of stock market corrections and crashes. And when you look in the past, you can almost look at cyclical price to earnings ratios and data like that, if that interests you. And you can almost kind of see that when stock markets crash, you tend to have very high price to earnings ratios, which means people are paying more for a certain earnings for the entire stock market. Now, I can't say exactly when a stock market crash is going to happen because I don't know. I can't predict the future. But looking at this current market in the United States, I think it's a freaking madhouse. And the reason I think that mostly is because of interest rates. Now, there's all sorts of theories people have. Oh, they're printing money and everybody's investing in the stock market, interest rates, yada, yada, yada. But at the end of the day, this market is extremely expensive. Now, I'm not telling you to sell your stocks. What I'm trying to prove to you is that you cannot concentrate your entire portfolio in one freaking country. And on top of that, you can't concentrate your portfolio in one sector of one country. A lot of people, it seems to me, are very focused on large cap tech stocks, large cap growth, whatever. Everybody seems to be piling into it. And it's a story as old as time where a certain sector of the market does good. And that creates a feedback loop where other people see everybody else doing good and they're enticed themselves to invest in that specific asset class. So you see stock prices start to get bid up and bid up and bid up. And what happens is the price of the stock or the price of the market, for example, becomes higher than its actual intrinsic value, what it is actually worth by discounting future cash flows, projected future cash flows. Now, I'm going to show you a couple charts, and I'm not here to scare you because I don't think you should ever sell your long-term investments, even if there's a freaking stock market crash. I'm not selling anything in my thrift savings plan or my Roth IRA, but I am not investing a lot of money right now in my taxable accounts because I don't like the stock market right now. But if you want to keep investing, there's nothing wrong with that. And the reason you shouldn't sell anything in your IRAs, 401ks, retirement accounts is because you just don't know. You could be wrong. You can miss years of gains. And if you're dollar cost averaging, you don't really have to worry about fluctuations in the market in the long run. So let's go look at a couple charts. And I want to show you why I think the US stock market is just insanely ridiculous, number one. And number two, I want to prove to you that you should have complete total world diversification and not throw all your money into the United States. Well, we got a question before I jump into it. Should I sell some of my funds? Maybe coming. No, I don't think you should. Well, I mean, I'll answer your questions after this, but if it's in a Roth, you shouldn't sell anything if it's in a Roth IRA or your retirement account. But if it's play money, you can consider it. It's up to you. All right. So the first thing we're going to look at, let me make sure it actually pulls up, is the Shiller price to earnings ratio. So there's I think he's at MIT or something, but his name is Robert Shiller. He's a very famous professor, economist that developed a stock market metric called the Shiller PE ratio or the CAPE ratio, which stands for cyclically adjusted price to earnings ratio. Now, price to earnings ratio, if you don't know, is literally just how many dollars you pay to buy $1 of earnings. You can have a trailing price to earnings ratio where you look at past earnings, or you could have projected future earnings and you could develop a forward price to earnings ratio. But Robert Shiller's PE ratio, and I believe he developed it with somebody else, I don't know their name, but he basically helped smooth out the volatility in PE ratios by taking the average of the last 10 years of earnings and then comparing that to the price of the stock market. So looking at this chart here, and let's go down first. The current Shiller PE ratio of the US stock market, and this is just the US, there's other stock markets around the world, is 37.42. Now, basically, think about it. The higher the PE ratio means the more you're paying, the higher the price you're paying to buy a certain amount of earnings. So the higher the ratio, especially compared to historical averages, the more expensive the market. Now, if you look at the market right now, it's 37.42. Look at the mean and the median. The mean is like the average. The average Shiller price to earnings ratio has been 16.82. Look at the market now. Let's see how much bigger it is. So compared to historical averages, the stock market is more than twice as expensive as it normally is. That's pretty freaking crazy, okay? And that could be just because earnings fell significantly because of the pandemic. But the question is, will the earnings actually grow to catch up with the prices that people have paid for the stocks now? And this is the S&P 500. But if we go back up to this chart, you can see you have Black Tuesday. That was like the stock market crash in the Great Depression. Black Monday, I guess that was a crash in the late 80s. And then you have this massive crash here, which was the dot-com bubble. Now, if you notice a trend, there seems to be a massive run-up in the cyclically adjusted price to earnings ratio before there's a massive crash or correction. You can see the trends everywhere. It goes up, it goes down, it goes up, it goes down. Now, if you look where we're at right now, the market is pretty freaking expensive, okay? Does this guarantee there's going to be a crash? No, it doesn't, because maybe earnings were just crushed because of the virus, but maybe they'll explode and catch up to the current valuation of the stock market. But if those earnings don't and they disappoint, we could potentially see a correction or a crash. So just looking at this, looking at how expensive the market is, for my investable funds for fun, I don't want to buy into the market, at least in the US stock market. Now, around the world, you may have much lower price to earnings or cyclically adjusted price to earnings ratio than you do in the United States. And like I said, I'm not trying to scare you, because if you're contributing money every month or 2 weeks into your IRA and 401k, keep doing it no matter what, because you're going to buy during the highs and lows. I'm not telling you to sell your freaking portfolio. What I'm saying is, don't be surprised if there is some kind of correction. And if there is, and your portfolio goes down, you shouldn't freaking sell if you're a long-term investor. That's called true diamond hands. Now let's look. There's actually another indicator that Warren Buffett uses. It's called the Buffett indicator. Now, instead of looking at cyclically adjusted price to earnings ratios, what Warren Buffett does is he compares the market capitalization, basically the total value of the entire US stock market, to the United States' current GDP. Now, historically, if we go down, it looks like the fair value of the stock market would be if it equals the current GDP, which you can see fluctuations. This chart's kind of confusing to read, but you have the line basically represents what the value of the stock market is relative to the United States' GDP since 1990. So when the line goes over this horizontal black line, that means the market is theoretically overvalued. And when it dips below it, it's undervalued. And if it's right on the line, then it's fair value. Now, look at the trend. I mean, look at this. So in the internet bubble, the stock market, or the Warren Buffett indicator, was basically indicating that the market was very expensive. And what happened right after that? There was a massive correction. There was a bunch of speculative mania and insanity about dot-com companies that didn't have any earnings. I see a lot of mania now. It's not as bad as then, because at least a lot of these hype stocks have some kind of earnings. But if you compare the height of the internet bubble, which is right here, to where we're at right now, the market's pretty freaking expensive, okay? This scares me. Now, am I terrified in the long run? No, I'm not. But I actually have a lot of cash sitting on the side, and I don't really want to buy in right now because I just don't like it. But what makes me feel better is I know that I'm exposed to the entire world because other stock markets around the world are not as expensive as the US stock market, not nearly expensive. So right now, just based on these two indicators, the market's very expensive. Doesn't mean you should stop investing. I think you should keep investing because it'll average out in the long run. But if you just have a lump sum of cash and you're like, oh, I just want to invest this, you need to be really careful and really think about what you're going to do. Now, we're going to move on to interest rates. Now, a big theory, and it kind of makes sense, is the reason that stock market valuations keep going up and up and up is because the 10-year Treasury interest rate, which is a U.S. government note or bond, the Treasury rate has been going down. So think about the stock market and the bond market. You have basically two alternatives. You can invest in stocks, which have a certain historical growth rate in earnings, or you can invest in bonds, which basically pay you a coupon every 6 months or a year. You're going to get an interest payment. Now, if you're an investor and you see interest rates start to go down pretty significantly, which means bond valuations go up, but the actual interest payment is going down and down and down. Wouldn't you personally rather invest in the stock market if bond rates become less and less attractive over time? I would say yes. So bond interest rates have significantly decreased since, God, it looks like 1983. They just basically started trending down. And we are almost at historical low interest rates right now. So since bonds are so freaking low, their interest rates are so crap, a lot of people are flooding into the stock market. And on top of that, how the stock market is valued is people look at projected future earnings and they discount those earnings based on a required rate of return. Now, part of that required rate of return is making more money or making a higher rate in excess of treasury rates. Because if you want to invest in a stock that's super volatile and there's a lot of risk, you at least want to have some assurance that you're going to do better than a completely safe treasury bond. So a lot of people, or a rational person, would only invest in stocks if they have a pretty good assurance that their return in the long run would beat a safe treasury. So basically, bonds are going down. They're not attractive. If interest rates spike, bond prices will go down as well. So I think a lot of people are flooding into the stock market. Now, there's all sorts of debates out there like, oh, stocks are fairly valued based on interest rates, yada, yada, yada. And that may be true. But what I worry about in the long run is our current federal debt, which is freaking exploded. Now, if you don't know much about debt and interest rates, basically the less likely that somebody is to pay off their debt, usually the higher the interest rate they're going to be charged. Now, our country is growing we're growing our debt pretty significantly. We had the virus, we had the Great Recession, we had a bunch of wars in the last 2 decades. Our debt has exploded, which I'll show you on this chart right here. So you see in 1980, so this is a debt to GDP ratio, which shows the percentage of debt compared to our GDP, which is basically our total spending that we've done in the entire country in 1 year. So the higher the chart goes, basically the higher the debt as a percentage of our economy we have. So you can see, it was pretty flat in the 70s and 80s. And then you see this gradual uptick, up, up, up. And then you see explosions in the last decade. And now we're sitting at 127% of GDP. So our country produces a certain amount of goods and services every year. And our debt is more than the total value of all those goods and services that our country produces in 1 year. So we're in a lot of debt. And then on top of that, you see the president's new spending proposal where he wants to spend like $6 trillion over the next decade every freaking year. And it looks like the debt is just going to keep exploding and exploding. Now, in my opinion, if a country is incurring massive debts and their debt keeps going and growing, there's going to come a point where I'm not going to want to lend them money. Or if I do, I'm going to want a higher interest rate because I might be concerned that the country might not be able to pay off its debts. You can't just go into debt to infinity, ladies and gentlemen. even if you're a wealthy country like the United States. Now, what that would do is that would probably increase interest rates. And on top of that, we might even have inflation with all the money printing that we're doing. We'll see what happens. But basically, fears that a government can't pay off its debts or increased fears and inflation could lead to higher interest rates. And when interest rates go up, a lot of stocks are going to go down, especially growth stocks, where their future earnings are way out into the future, which means the discount rate will significantly decrease the present value of that future cash flow. That is why I am really concerned, at least in the short term, about the US stock market. Now, to close this video out, I never sell ever for anything, except if it's like, play money. I don't worry about short-term fluctuations in the market. Sometimes the market's going to be overvalued. Sometimes it's going to be undervalued. Your best strategy is to buy consistently, dollar cost average in tax advantage accounts. And in my opinion, I think you should invest in a total world stock market index fund because that exposes you not just to the US stock market, which historically is very expensive right now and is at risk of being hurt by rising interest rates and inflation. Because if you're exposed to the entire world, you're not concentrated in one country. That's number one or number two. And the last thing I'll say, unless you have any questions, is if you have play money, I'm not going to tell you what to do with it. But me personally, I'm going to put my money. I have like a couple $1,000s. I won't say how much so you don't rob me and try to sue me. But I have a decent chunk of money that I've been wanting to invest. Now, what I'm going to do, instead of just throwing it into the US stock market or even the total world stock market, and this is my play money, this is not for my Roth or 401k, I'm just going to keep it in short-term bonds, which are less subject to interest rate risk and inflation risk. And I'm just going to hold them there. And if there's a correction, great, I can go ahead and buy in and maybe buy at a low. If there's not, then I'll just have to wait until there is. But there's nothing wrong with having very short-term bonds in your portfolio because the longer the duration of the bond, the longer the term of the bond, the more sensitive it is to interest rate risk. So if you want a cash reserve, you can either keep it in a high yield savings account, or if you want to move it into your brokerage and have it sitting there, you could put it in very short-term bonds or very short-term inflation protected securities. And Vanguard offers both. It's up to you though. You can just keep it in your savings account. But that's kind of what I'm doing right now because I personally don't like this US stock market right now. And I really never have. I've never understood why they put all their money in the US stock market, like America's going to be the future for the next 30, 40, 50 years. I don't believe that. So if you take one thing from this, ladies and gentlemen, consider international investing. I personally invest in the Vanguard Total World Stock Market ETF, and that's basically the bedrock of my portfolio. You don't have to do that, okay? But you need to kind of determine what works for you, and you need to consider the risk that the US stock market might not have the amazing performance that it has had in the last couple of years or even decades. So just be very careful, rationally think through your investing process. And if the market does crash, don't freak out, stick to your plan, and I think you'll be fine. Now, let me see if there's some questions. Should I sell some of my funds if a market crash? Nah, I think I already answered this. You don't want to time the market. If it's play money, sure. If you think there's a crash. But if it's in your retirement accounts, I never touch them. I have my plan, I stick to it, and I contribute to them every 2 weeks, month, whatever. Because in the long run, even if there is a crash, it doesn't matter, especially if you're young. But I'm saying right now, if you have like play money or you're thinking about putting all your money into the stock market right now, even your savings, don't do that. Okay, I hope you don't have fund managers, or if you do, then they're just index fund managers because actively managed funds are very expensive. UK furlough scheme in soon. Yeah, I think we have this. We have like unemployment insurance, but I think that's going to end. I actually haven't been reading the news that much when it comes to unemployment. It's all tied up in, but I'm just trying to time the market. I don't have the patience. All right, look, you need to have the patience, man. I have two buckets. I have like my little play money and my savings, and then I have my retirement assets. I don't touch my retirement assets. I put them in low cost index funds, and I buy them consistently week after week after week because that's dollar cost averaging. And you never know when the crash is going to come. So that's why I don't touch my retirement assets. Because if you screw up one time, if you sell at the wrong time or try to buy in at the wrong time, it's going to hurt you in the long run. But if you just keep it there, stick to your plan, you'll be fine. But if you have play money, maybe consider reallocating. I mean, I'm not going to tell you what to do. It's your choice. But me personally, I'm not just going to YOLO all my money into the S&P 500 because I don't like it right now. That's when the crash will come. So that's it, ladies and gentlemen. Actually, I'm on my lunch break. I need to go back to work. But if you haven't already, like, subscribe to my channel, buy my book, Stop Being a Broke Loser. It's on Amazon. And stay the course. There may be a crash. Don't be surprised. But long-term investors win when they don't freak out and sell. So stick to your plan, dollar cost average into your retirement accounts. And if you have play money and you think the market's overvalued, okay, sell it, whatever. But don't touch your retirement assets. Y'all have a wonderful, delicious day.